So let me ask you, if you're long-term bullish on a stock and you're thinking about selling monthly put spreads, which strikes should you choose? Well, in this video, we're going to compare put spread strike selection on Amazon the past 3 years. We know the stock's been just going crazy. They're taking over the world. But what we're going to focus on tonight is a little bit of the math if you're bullish on a stock when you're selecting those spreads. Now, it's important to understand that this information is for educational purposes only, and it's really meant to show you some of the math of the results when we look at the Amazon trades, and it's definitely not financial advice. So I think the most interesting thing when comparing the different strike prices, which we'll look at here in a minute, is the difference in the returns, the win rates, and the average win versus loss. Now we know with high probability spreads, if your win rate gets too much, when that loser comes, it can be a big one. So that's something we're going to be looking at tonight. And if this is your first time stopping by the channel, take a second to subscribe. It'd be really cool if you could like the video, help spread the word. My name is Eric. You're watching Liquid Options, a weekly show about options. And I post this every Wednesday night. Comparing strike price selection when selling put spreads on Amazon is coming right up. All right, as I've already mentioned, we're going to be taking a look at Amazon because it's been one of the most bullish stocks, and I want to use them as an example because it's so bullish. And what I want you to get out of this is not that you have to pick a bullish stock to make money selling put spreads, because that's kind of what we're going to focus on. But what I want to do is just use this as an example to look at the compare strike selection when you do trade put spreads on a bullish stock. Now, for me, I still personally like the 200-day moving average. If a stock's above that, I think it's pretty bullish. Also, I think the slope of the 200 is important, but that's really not the focus of this video. Again, we're going to look at some strike selections, but I wanted to just throw up a 3-year chart of Amazon. And again, this line, this maroon line, this is the 200-day moving average. And if you've seen some of my previous videos, I like the little price channel here, so you guys can go back to some of the last couple episodes and look at that. But again, we're bullish on Amazon, and let's take a look at our backtesting software to start looking at some strike prices. So I'm using CML Viz Trade Machine Pro to do this back testing. I'm going to put a link in the description, as well as I'll put a pinned comment on this after I post the video. But if you're interested in messing around with this software, it's really, really cool. They got I've featured some of the other things. We're going to look at the back test tab, but they also have the Pro Scanner and some of the other strategies that they recommend and things. So, but basically what we're going to do is this. We're going to look in Amazon. I'm going to put in the ticker. I have 30 days here. We're going to look at 30-day, which is the standard monthly options. We're going to look at put spreads. We're going to sell put spreads, and we're going to put on 3 years. And I've already sort of pre-filled the delta selection here, and we'll talk about that for a second. While this is running, we'll look at this. So I did not choose to avoid earnings, but that's some, I'm just kind of straight up looking at trying to sell 30-day credit spreads on Amazon the last few years. And again, we're going to compare the win rates and stuff, but there's some other options in here if you want to mess around with, well, what if you took profits at 50% and you put in stop losses? So there's other things you can do with the back testing, but again, that's not the focus of this video. So first thing I want you to not look at is the percent return. This is a little, you see these big, huge numbers, and really what that is telling you is the profit based on the risk. And I don't want to get into margin and all these things with credit spreads, but what I want you to look at is the deltas that we're looking at. So from left to right, I start with slightly in the money put spread. So we would sell a delta 60, we would buy a delta 59, and I've set it like that so that we basically get about a 1 strike credit spread across the board. And depending on where those deltas land you on the option chain, the average trade or average risk can be a slightly different. But this is about as close as I could get to kind of compare across the board. So the first section here is we're selling a delta 60 spread. So delta, whatever the delta 60 is, and then about the next strike, delta 50, delta 40, delta 30, delta 20. So many of you if you've been following me or any other option traders in the world, we typically would sell out of the money option. So out of the money would basically mean delta 50 or below. Delta 50 is about right at the money, and we'll look at the option chain in a second, but everything else is slightly out of the money. But I wanted to put the in the money one just to compare some of the sort of percentages and the wins and all these things. So when you look at the total return, now this, again, these weren't real trades, these are back tested, so you got to take this with a grain of salt, but you can see that the total return for selling an in the money put spread was actually better than selling the out of the money. So when you compare these two, you made a lot more money selling the in the money put spread, but your win rate was a lot lower. You had a 61% win rate. You won 24 times, you lost 15 times. Now, this assumes that you're holding to expiration, and again, does not take into account any kind of management or adjustments or anything. This is straight up selling this spread and holding to expiration, which you wouldn't want to do. You wouldn't want to get a sign and all these things. Again, we're just looking at the math of it. You could close the trade before expiration, but real quick, before we get into the wins and losses and things, let's just take a look at the option chain, and so that we can see where these kind of line up. So again, we're looking at delta 60, 50, 40, 30, 20. So I'm going to take a look at the options that currently, as of this video, have 30 days left. Now, keep in mind that the software we just looked at is looking at the monthly option. So you'd want to not, take this trade, obviously, but you would, I just wanted to point out that this is not looking at weeklies, but to give you kind of a fair delta distance thing, I wanted to use 30 days to expiration, which is about what the software is looking at. So if I go to the July 18th as of, or July 6, 2018 expiration, this is a weekly, but it is 30 days away. So if I expand this, let me drop these strikes down a little bit so we can close them in here. So we're looking at the put side over here. And again, the first put was the delta 60. So the delta 60 is an in the money put. It's the 1725. So if I were to right click and sell this vertical, in this moment, I could get about $3 for that trade. So when we have a $5 strike width, and this is important when you're comparing the strikes, the most you can lose here with the credit is $2. So when you're selling in the money put spreads, which is not, again, I'm not recommending you do this. I just wanted to kind of show some examples with the math. Your risk reward, you're actually risking 2 to make 3, or if you sell out of the money, you're usually risking risking 3 to make 1. So it's a little bit skewed. So, but regardless, if you're looking at the 1725 put, if I come in here and I look at the chart, 1725 is above the current price. It's right about this level. So in order for this put spread to make money, the stock has to rally. So again, this is why we're looking at a bullish stock. The stock would have to rally. So if you are bullish, you could put something that's closer to the money with the idea that if you believe it's going higher, then your risk reward is actually a little bit better in your favor. But again, it's not the high probability credit spread as we saw in the win rate. The probability is not high, other than your bullish thesis. So hopefully that makes sense. But regardless, this is where the delta 60 gets you. So the delta 60 put spread 30 days away is above the current price, and you would need price to rally through that and close above that level so that the put spread could expire worthless, and then you could keep, in this case, the $3, and you wouldn't have to close it, kind of thing. So let's go back to the software. So the delta 60, again, the win rate is not that great. The only reason you have a win rate is because, or a positive win rate, is because the stock was so bullish. Because it was so bullish, you could, in theory, you could have sold put spread slightly in the money and done pretty well. Now, again, you'd have to be right. If the stock is bearish or turns bearish, then obviously this is not going to be good. But again, what I want to focus on here is the win rate. So this is a lower probability trade, but because it was so bullish, you were able to get a positive win rate and a positive return because the risk reward inside of that spread was skewed for, you know, obviously a bullish, you needed a bullish move, but the risk reward's a little bit different as opposed to the out of the money spread. So let's look at this one. This is the Delta 20, and you can see we had 37 wins and 2 losses. And we're going to look at the average win and loss here in a second because I think it's super interesting. But real quick, let's just go back to the option chain and look at where a Delta 20 would be. So if I come in here and I look at the same month, but I want to go Delta 20, Delta 20 is way, actually, I got to add more strikes. Delta 20 is way, maybe even more, 60? There we go. Delta 20 is way down here at 16.15. So let's take a look at that. So if I were to sell this vertical now, because there's half strikes, I'm going to, so it's kind of compared, I'm going to do we'll sell a vertical, sorry, and we'll do a 210 just so we have the same width here. So I got 87 cents in this moment. Now that's way less than the $3 we looked at. So because the credit is less, the risk is more, but it's higher probability. And that's the constant thing that credit spread traders have to deal with, is the risk, reward, and probability. And what is your comfort zone? Are you the type of person who wants a higher win rate because your ego can't handle the losses? Or are you okay with a slightly better win rate, but you avoid the big losses? So what's more damaging to your own sort of ego and psyche? And let's take a look at this, because I think this is going to help clear that up. So let's look at the first one here, and there's some stuff in the middle. But if I click on this tab, and again, I'm in the software, I click on this tab, the average win in the Delta 60 spread the last 3 years was $219. That was the average win. Again, the strikes are going to be a little different for each month and stuff. The average loss was 138. So let's just think about that for a second. Your win rate was only 61%, but your winners were bigger than your losers on average. Okay, so this is a different type of, I think, a different type of mentality, where if you're just bullish and you think the stock is not going to go down, now maybe this is a little bullish. I personally wouldn't sell Delta 60 put spreads, but I just want to illustrate the math here. Is the average win, the winners are bigger than losers, and you have more wins than losses. Okay, so that's, I think, a different approach or mindset that you're going to need to trade something like this. So let's back out of this. Let's go to the other end. Let's go to the Delta 20. So again, the win rate, almost 95%, 37 wins, 2 losses in 3 years. But let's take a look at this. Your average win was $79, but look how big the loss was. The loss was $600. So if you think about this, you're doing every month, you'd win 6 or 7 months, and then you had a month that wiped out basically half a year of profits. Now that only happened twice in 3 years, and it actually reduced your overall win rate. I'm sorry, your total return. You made $1,600, but you have this 95% win rate. So you're going to feel better for 37 times, and then you're going to feel really crappy these last 2 times. I don't mean to laugh, but that's what we have to deal with. We have to deal with, well, where are you comfortable? Are you comfortable with 95%? Of course, everyone's comfortable with 95%, but are you comfortable losing several months of gains 1 month because, that's going to happen, right? That's going to happen. It happened for me in the beginning of 2018. I had a great run, and then boom, had some big losses when the volatility spiked in January. I'm okay with that because that is the game I play. That is how I approach it. Now, I tend to end up somewhere around Delta 30. Now, I have some other technical analysis things that I've done in previous videos, but let's take a look at some of the other ones here. So again, the best number performer here from a total return was actually the Delta 50. So Delta 50, let's go to the option chain. Delta 50 is basically right about current price. Delta 50 here is 1,700. Right, so if I go here, we're trading at 1714. So 1700 is actually slightly under here, but you're basically right. Oh, that's the high. I'm sorry. We closed at 1695 1714 was the high today. We closed at 1695, so 1700 is, you know, just above that level. So we're going to call it at the money within a couple bucks. But again, Delta 50 actually made the most money, and you can see that the win rate actually increased. But let's take a look at the wins and losses. So the winners are still bigger than the losers, but not by that much. They're pretty close. Yet your win rate's improving. So again, this is a different mindset. Winning 70% of the time, I'm totally fine with that. And if you can win 70% of the time and your winners be better than your losers, or at least the same, you know, you do that all day long. Obviously, your bullish thesis needs to play out for these numbers to work. But if you're bullish, then this is something maybe you could consider for whatever particular stock you're looking at. So let's go with something that's, you know, a little slightly out of the money, a Delta 40. Again, we'll go to the option chain here. Delta 40 puts us at 1675. So we come in here, 1675 is right around this level. So you're actually under. So you have a little, you can be a little bit wrong and still make money, which is going to give you the higher win rate of 80, you know, call it 80%. But look what starts to happen here. Yes, your win rate's higher, but the average win starts to be a little bit less, and now your loser is actually slightly bigger. But your win rate is still enough to offset those losses. So I'm not going to go. Well, okay, we'll go ahead and look at the next one. Delta 30. Now our loser becomes twice as big as our winner, but your win rate gets closer to 90%. The money's still pretty decent. So there's no silver bullet here about which strikes you should choose, but I did want to illustrate if you're bullish on a stock and you know you can look at different strikes, you don't always have to sell so far out of the money, because the day that it turns on you, you're going to get that big loss. So this is something I think is a personal choice for everybody. I get a lot of questions about, well, how much do you risk, and what are the, you know, what strikes should I sell? And hopefully this video just kind of showed you just the choices that you have to make and what the pros and cons are for each one. And I personally think it's more of a psychological thing. I find myself usually in the Delta 2030 when I trade indexes, but indexes I think are a little bit different. So when I'm bullish, I look for a little bit more of a tactical entry, but I'll go with a Delta 50 or 40. If you're using technical analysis and you think that the stock's pulled back and now you're ready to get in, then I'm okay with selling something closer to the money. Now, at the same time, I might take partial profits, that kind of thing. But again, I hope this video helped you understand a little bit of the difference between out of the money options versus in the money when you talk about selling spreads, as well as comparing the win rate, average win, average loser, and just kind of what you got to go through when you're dealing with that stuff. So again, check the description if you want to learn more about CML Viz. And what I'd really like to know, if there's another stock or strategy you would like to see me show an example here, please put it in the comments section, and I'll look at making a video on that next time maybe. All right, you guys have a great night. Don't forget to check in next week, subscribe to the channel. I'm going to post a video here every Wednesday night as much as possible. You guys have a great night. I'll see you next week.